Apple has done it again. The company just delivered another massive earnings report, beating Wall Street expectations with stronger revenue, record services growth, and impressive profitability. But despite the strong numbers, investors are now focusing on one critical question. Can Apple continue dominating the tech industry in the AI era, or is growth beginning to slow for the world's most valuable company? In this video, we'll break down Apple's Q1 2026 earnings, analyze the company's financial strength, valuation, and explore whether Apple still has long-term upside from here. Apple is one of the most influential technology companies in the world, best known for products such as the iPhone, Mac, iPad, Apple Watch, and its growing services ecosystem. Founded in 1976, Apple has evolved far beyond a hardware company. Today, it operates one of the strongest consumer ecosystems globally, combining hardware, software, services, and premium branding into a highly integrated business model. One of Apple's biggest strengths is customer loyalty. Millions of users remain deeply connected to the Apple ecosystem through services like iCloud, Apple Music, the App Store, Apple Pay, and other subscription-based platforms. This ecosystem creates recurring revenue, high switching costs, and exceptional profitability, helping Apple maintain some of the strongest financial metrics in the entire market. As artificial intelligence, cloud services, and digital ecosystems continue to evolve, investors are now watching closely to see whether Apple can transform its massive global platform into the company's next major growth engine. From a market position perspective, Apple remains one of the strongest players in the global consumer technology industry, although competition across several segments continues to intensify. In the smartphone market, the iPhone continues to dominate the premium segment globally, competing primarily against Android manufacturers such as Samsung and Chinese brands including Xiaomi and Huawei. While Apple may not lead in total unit market share, the company generates a disproportionately large share of industry profits thanks to its premium pricing power and loyal customer base. In personal computers, Apple's Mac business competes against Windows-based manufacturers such as Dell Technologies, HP Incorporation, and Lenovo. The introduction of Apple Silicon chips significantly improved performance and efficiency, helping Apple strengthen its position in the premium laptop and productivity market. Apple also maintains a leading position in wearables through products such as Apple Watch and AirPods, where the company benefits heavily from ecosystem integration. Competitors may offer cheaper alternatives, but Apple's seamless connectivity across devices remains a major competitive advantage. However, one of the most important long-term battlegrounds is ecosystem and cloud services. This is where Apple's business model becomes both extremely powerful and somewhat vulnerable. Apple's ecosystem is arguably one of the strongest in the world. Services such as iCloud, Apple Music, the App Store, Apple Pay, and device synchronization create a highly integrated user experience that encourages long-term customer retention and high switching costs. But compared to cloud leaders such as Microsoft, Amazon Web Services, and Google Cloud, Apple is not considered a dominant player in enterprise cloud infrastructure or AI cloud computing. Apple's strength lies primarily in consumer ecosystem integration rather than large-scale enterprise cloud services. While competitors dominate enterprise AI and cloud infrastructure, Apple focuses more on user privacy, device integration, and premium consumer experiences. As AI becomes increasingly important across the technology industry, investors are closely watching whether Apple can leverage its ecosystem advantage strongly enough to compete in the next phase of AI-driven computing. Apple delivered one of the strongest quarters in its history during fiscal Q1 2026, significantly beating Wall Street expectations across both revenue and earnings. The company reported total revenue of approximately $143.8 billion, up 16% year-over-year, while diluted earnings per share increased 19% to $2.84, both setting new all-time records for Apple. The biggest driver behind the strong performance was the iPhone business. iPhone revenue surged to roughly $85 billion, supported by exceptionally strong demand for the iPhone 17 lineup across multiple geographic regions. Apple's services segment also reached a new all-time high, generating around $30 billion in revenue and continuing to strengthen the company's recurring revenue model. Profitability remained extraordinary. Gross margin expanded to approximately 48.2%, reflecting Apple's strong pricing power, operational efficiency, and the growing contribution from its high-margin services business. Apple also generated nearly $54 billion in operating cash flow during the quarter, allowing the company to continue aggressive share buybacks and dividend payments while maintaining one of the strongest balance sheets in the market. Another key highlight was the continued expansion of Apple's installed base, which now exceeds 2.5 billion active devices globally. This massive ecosystem remains one of Apple's biggest long-term competitive advantages, supporting recurring revenue growth and strong customer loyalty. Overall, Q1 FY 2026 demonstrated that despite concerns about slowing hardware growth and increasing AI competition, Apple continues to operate at an extraordinary scale with exceptional profitability, cash flow generation, and ecosystem strength. The market reacted positively to Apple's Q1 FY 2026 earnings report, as investors responded to the company's record-breaking revenue, strong iPhone demand, and continued services growth. Shortly after the earnings release, Apple shares moved higher in after-hours trading as Wall Street digested stronger-than-expected results across both revenue and earnings. Apple reported record revenue of nearly $144 billion and record EPS of $2.84, significantly exceeding analyst expectations. Investors were especially encouraged by the massive strength in iPhone sales, which surged more than 23% year-over-year and reached an all-time high. Strong growth in China also helped improve market sentiment after previous concerns about weakening demand in the region. Another key driver behind the positive reaction was Apple's forward guidance. Management projected double-digit revenue growth for the following quarter and guided gross margins higher than Wall Street expected, reinforcing confidence that Apple's ecosystem and premium pricing power remain extremely strong. However, despite the strong earnings beat, investor reactions were not entirely euphoric. Some concerns remained around rising component costs, supply chain constraints, and Apple's long-term AI competitiveness compared to other big tech companies such as Microsoft and Google. Overall, the earnings report reinforced Apple's position as one of the strongest and most profitable businesses in the world, while also highlighting that investors are increasingly watching how Apple plans to compete in the next phase of AI-driven technology. Now, let's take a look at a small portion of Apple's financial ratios for fiscal years 2025 and 2024. In FY 2025, Apple reported a gross margin of 46.91%, improving from 46.21% in FY 2024. The improvement reflects Apple's continued ability to maintain premium pricing power across its ecosystem while benefiting from a growing contribution from high-margin services revenue. Despite operating in a highly competitive consumer technology market, Apple continued to demonstrate strong cost efficiency and brand strength, allowing profitability to remain at an industry-leading level. Apple's ROIC increased significantly to 66.68% in FY 2025, compared with 53.62% in FY 2024. This sharp rise indicates that Apple became even more efficient in generating profits from the capital invested in its business. A ROIC above 60% is exceptionally strong and highlights the company's powerful competitive moat, efficient capital allocation strategy, and highly profitable ecosystem-driven business model. In FY 2025, Apple generated an FCF margin of 33.17%, up from 26.89% in FY 2024. The expansion in free cash flow margin shows that Apple converted a larger percentage of revenue into actual cash flow. This improvement strengthens the company's financial flexibility, enabling continued investments in innovation, aggressive share repurchases, dividend payments, and strategic expansion initiatives. Apple's interest coverage ratio surged to 390x in FY 2025, compared with 33x in FY 2024. This extraordinary increase indicates that Apple generated operating earnings vastly exceeding its interest obligations. The result reflects an extremely strong financial position with minimal debt servicing risk. Overall, Apple's balance sheet remains one of the strongest among global technology companies, providing substantial resilience even during periods of macroeconomic uncertainty. One of Apple's biggest positive catalysts is the continued growth of its high-margin services business, including the App Store, iCloud, Apple Music, and Apple Pay. This segment provides recurring revenue and helps strengthen overall profitability. Another major catalyst is the AI-driven iPhone upgrade cycle through Apple Intelligence, which could encourage millions of users to upgrade their devices over the next few years. Apple also continues to benefit from one of the strongest ecosystems in the technology industry, with more than 2 billion active devices worldwide, supporting customer loyalty, premium pricing power, and long-term cash flow generation. Finally, Apple's enormous free cash flow and aggressive share repurchase program continue to support earnings growth and shareholder returns. One of the biggest risks for Apple is slowing iPhone growth, as the global smartphone market has become increasingly mature and replacement cycles are getting longer. Since the iPhone still contributes a significant portion of Apple's revenue, weaker demand could pressure future growth. Another key concern is increasing competition in artificial intelligence. Competitors are moving aggressively in AI development, and if Apple fails to deliver compelling AI features, it could weaken its competitive position over time. Apple also faces regulatory pressure in multiple regions, particularly related to the App Store ecosystem, payment systems, and antitrust issues, which could impact services revenue and profitability in the future. In addition, the company remains exposed to supply chain and geopolitical risks, especially due to its heavy manufacturing dependence on China. Now, we are looking at Apple's valuation, where its fair value is estimated to be around $254, while the current share price appears to be relatively overvalued. Apple's new partnership with Intel, along with efforts to reduce its dependence on Taiwan's Semiconductor manufacturing company, TSMC, has increased investor confidence in Apple's long-term prospects. Analysts estimate that Apple's stock price could potentially move toward the $400 level in the future. However, investors are advised to remain prudent and carefully consider every investment decision. Apple continues to demonstrate exceptional business quality, supported by strong profitability, massive free cash flow generation, and one of the most powerful ecosystems in the technology industry. Although the stock currently appears relatively overvalued compared to its estimated fair value, investor optimism remains strong due to Apple's long-term growth potential, expanding services business, and growing AI ecosystem opportunities. The company's strategic partnership with Intel and efforts to diversify semiconductor supply chains beyond Taiwan's Semiconductor manufacturing company, TSMC, have also strengthened market confidence in Apple's future resilience and scalability. For long-term investors, Apple remains a high-quality company with strong competitive advantages. However, valuation risk should still be considered carefully, especially after the stock's strong price appreciation. Investors are encouraged to remain disciplined and align investment decisions with their own risk tolerance and investment horizon. This content is for educational purposes only and does not represent financial advice. Thank you for watching, and don't forget to like and subscribe for more insights.